Thank you, everyone, for joining us today for our webinar series. Today's part one is called An Overview of Pension Funds, and it is organized by Grain and hosted by A Growing Culture. My name is Diljit Korsoni, and I'm a workers' rights attorney focused on food systems transformation. We are here today thanks to more than 10 years of research by Grain in demystifying the complicated web of ghost corporations and subsidiaries with unfettered access to the largest pool of capital in the world, the deferred wages from the workers of the world, amounting to more than $52 trillion in assets. The purpose of this webinar is to help activists and community leaders understand what pension funds are and to begin thinking about how we can resist this. How can we stop this investment, how can we stop this destructive investment in food and ag that is really exacerbating and accelerating the rate of climate change and also the privatization of our public services. Today's webinar is part one of two, and you will hear from Kevin Scarrett, who is a senior policy researcher at the largest union of public employees in Canada called QUIPE. He has been grappling with these issues for more than 2 decades. He has a lot of passion and is going to help us break down how these pension funds operate in multiple parts of the world and really serve as fuel that keeps global capitalism running. Who will also help us to understand the impact of pension funds on our climate, our food systems, our system of governance, and as well, recent trends. And so we know this is a lot of information and it's dense, it's copious, so we will take a break halfway through. So I encourage you to try to keep track of your questions, anything that you want clarification on, and you can ask it during that short 10-minute period. We will also hear from Devlin Kuyek, and after that, we will begin our lesson on Pension Funds 101. And at the end, we'll have a longer 20-minute Q&A session. For those sessions, you're going to use the raise hands feature, which you can find at the bottom of your screen. You can use that for your questions or directly place them into the Q&A box. And we also are providing live interpretation today in French and Spanish. To select interpretation, click on the globe icon at the bottom of your screen, and you can select either French or Spanish. And now I would like to introduce Devlin Kuyek. Devlin is part of the global team at Grain and is based in Montreal, Canada. He has been with Grain for nearly 2 decades and has focused his research on land grabs, which are increasing at an alarming rate. Devlin, welcome, and please introduce yourself to the audience.
Thank you, Daljit. Well, as Daljit was saying, I work with Grain. We're a small team based in different parts of the world, working to support people's control over biodiversity and local food systems. And before I turn things over to Kevin, I wanted to give a little explanation of our aims and intentions with organizing this series of webinars. We at Grain came to this issue through our engagement and struggles around food sovereignty. About a decade and a half ago, during the last food and financial crisis, we were alarmed as financial actors started to get much more directly involved in food and agriculture. They started buying up farmland around the world and setting up private equity funds to take over farms and food companies. And as we dug deeper into this, we came to realize that a major source of money behind this, if not the largest source of money behind this, was coming from pension funds. And this was, for us, a bit of a shock, but we immediately started to wonder if this then created some opportunities to form alliances with labor, and particularly those workers whose deferred wages were being used to displace communities and destroy local food system. So we started talking with labor groups who have been working on pension fund issues for ages, particularly the International Union of Food Workers, the IUF, which has a very long history of work on the financialization of the food system. And we began to reach out to different organizations to try and build some alliances across countries, see if we could push back on land grabs, push back on pension funds investing in land grabs. Now, it's been a steep learning curve for us and one that we're very much still on. And this work continues to throw up a lot of questions and doubts for us, but we are very convinced by its importance. And as Kevin's going to explain in much greater detail and much better than I could, these pension funds provide one of the largest pools of capital for global finance today. And they are increasingly involved in some of its most predatory forms of investment and speculation, touching all aspects of our lives in all corners of the globe. And it's equally troubling for us that the conditions for elderly people are deteriorating. Very few people have anything close to a living pension to rely on in their old age. So it's clear that the current system, wherever you are, is broken, and that we need an alternative that is radically different. We know this is a huge challenge, but dealing with it is central to our ability to deal with any of the major crises affecting our planet. We sort of began this process back in April 2021, so over a year ago. And our initial idea was to have a set of conversations. That's where we're at. We don't have any ready-made answers, but we feel it's really important to create a space where we can collectively deepen our understanding of this issue and consider how we can take actions that are effective. So this first webinar is really meant as an overview. It's a chance for us to get to a common level of understanding. And then we're going to have a second session on June 9th, where we'll look more at actions and bring together different experiences of different parts of the world and different sectors. And in that second section, there's going to be a considerable amount of time allocated for audience participation. So please also come to share your own experiences. And I also really want to emphasize that this is for us just the first step. We hope that this will lead to more collective conversations and some potential collective actions. So please do, if you're interested in exploring this further with us, please do get in touch so we can then start thinking about what we can do collectively following up from these webinars. And lastly, I'd just like to thank the wonderful team at A Growing Culture for the fantastic work in supporting the organizing of these events. I'd like to thank Daljit for agreeing to facilitate, and also Peter Rossman from the IU, formerly with the IUF, and Kevin, of course, for their guidance throughout this process. So without further ado, let me turn things over to Kevin Scarrett. And I just want to add, Kevin is not only had 2 decades of experience dealing with this in one of the world's most important unions dealing with this issue, CUPE in Canada, but also has worked with trustees on pension fund boards, and himself recently became a trustee. So he has also an inside perspective, which I think is really important to understanding this issue. So Kevin, please, over to you.
Thank you very much, Devlin. And thank you, everybody. I'm going to just take a quick step and share my screen, let people know that I will be using a slide deck for this session. I hope it's a helpful slide deck and that it's, it can be followed without too much problem. I want to make sure it is visible to everybody. I just need somebody to give me a thumbs up that it is visible. And just to add very briefly to Devlin's introduction to me, which I appreciate, I'd like to, also extend my thanks both to Grain and A Growing Culture. There's a whole team of people that's put this together, which I greatly appreciate. I'm learning about food sovereignty, food security issues, which is not one that I've worked on a lot in the past, but I'm absolutely convinced of its importance. My own background in a public sector trade union has me focused more on public services, public infrastructure, other things that are affected, which I'm going to talk about. But it's just been very helpful to make this connection for this session and to get into this discussion. The other thing I want to say, I am a researcher for CUPE, as has been said. I don't represent CUPE in this particular case. I'm speaking on my own accord. That is my affiliation. I'm also an adjunct and affiliated with the Institute of Political Economy at Carleton University, which happens to be where I did my one of my degrees some time ago, and I'm happy to have that affiliation. Okay, let me dive straight in. This is our agenda. I've given about 40 minutes to try to get through this, and as Devlin said, lay a sort of a groundwork for this sort of daunting and difficult technical topic. We're going to try to break it down and explain it for anyone who is interested in these issues. I want to talk about this concept that's in the title of the session, pension fund capitalism, then talk a little bit about the basics of how pension funds are invested and structured in the financial system. And also I'm going to talk about how pension plans are governed and how decision-making around investment policy is made. At that point, we're going to take a pause, as has been said, for questions, and then we'll turn to a couple of very specific, troubling and disturbing projects that pension funds have been central actors in. I have one that I want to share in particular, and Devlin is going to help me explain one that actually more than one that affects food sovereignty and agriculture. And then we're going to conclude with a section on really strategies for resistance. What do we do about it? What can we do about these difficult problems? So that's our agenda, and I'm going to move right ahead and dive in. So the first thing I just want to share is this concept in the title, pension fund capitalism. What is this term, and what is intended by it? It is actually a term that's been around now for a couple of decades as the size of pension funds in the economy, both sort of the domestic economy, but also internationally, became recognized. There's a number of writers that have started to take up this language. And in fact, I worked with a group of colleagues on an edited volume with the title The Contradictions of Pension Fund Capitalism. This is a book that was published by Cornell University Press back in 2018. If anybody's interested in further reading on the subject, that is one place to go. There's actually also some more recent work. Leokadia Oreziak, a Polish economist, just published a book called Pension Fund Capitalism, and she does a very helpful survey of the topic. And what is the topic? Well, as I say, analysts that use this language, we talk about the size of pension funds now in the global economy, as measured by one study. $56 trillion US are invested by pension funds from the 22 largest pension fund source countries. So the sheer scale of this is now enormous and significant. The second point to make, though, is and this is what we're going to talk about today. People view pension funds historically as passive investors in the stock market and the bond market in a very passive way. But in fact, as Devlin suggested, this has changed in recent years, particularly the last 20 years. There's been nearly a revolution in how many pension funds are actually invested in troubling ways that we're going to talk about. I'm not going to speak a lot about this third element, but I'll mention it briefly a couple of times. For me, another important thing to register about pension fund capitalism, there's an irony in this, and that is that, in fact, as pension funds have really launched into the global economy as these aggressive investors, it just so happens that this is happening at the same time as the neoliberal turn in policy has actually turned against pension benefits for workers. There has been a long term, over the last 30 years, many pressures and attacks on secure pension commitments from public systems, workplace-based systems, and so forth. So there's an irony and a bit of a contradiction in that. And that's why I say in my last point here, for me, there is a kind of an ultimate contradiction. And as a trade union researcher that cares about secure retirement income, there's this awful irony, and I would say contradiction, that workers who need pensions have become dependent on these systems, these investment funds that are investing sort of in their name, in some sense with their money, to generate financial profits in the capitalist financial system, which itself more broadly has become even more destructive and predatory. That's a contradiction that I think we need to talk and debate much more about. This is a slide that speaks to what I just said. I'm not going to speak in detail about how pension benefits themselves are structured, but I do want to just recognize that what I was just describing about the shift against secure pensions and retirement incomes, this is a process that, we could actually date to the 1990s, maybe the 1980s, but particularly the 1990s, when the World Bank and other international institutions started to press very hard, supporting what we call Chilean-style individual accounts for retirement to get out of the strong public systems of pension benefit promises and moving into individual investment accounts where the risks of investment are actually transferred to individuals. If the investment goes well, maybe you do better. If they don't go well, you lose as an individual, and you don't have an employer or a pension plan or a government that's there bearing and sharing those risks. Also to say, in the last 20 years, it's important to underline that the systems for providing pensions to workers, and it has to be said, these are very disproportionately like pension systems, in particular funded workplace systems, are much more established in the global north and the highest income countries. Where we have those systems, like in Canada, where I'm based, the costs of actually providing pension plans, secure defined benefit style plans, and when I say defined benefit, that's a term that basically means guaranteed benefit. The cost of doing that has actually been increasing for a number of financial reasons. Long-term declines in interest rates. In fact, the improving longevity of workers. If people are going to live longer and receive pensions longer, it's going to cost more. And there's other factors that I have to acknowledge, actually objectively increase the cost of pensions. And so employers and governments have responded to that by saying, well, we either need to cut these pensions because we don't want to pay for them, transfer the cost to you, or I might say, or seek higher rates of investment return on the investments behind them. It's given them an extra incentive to search further and in different ways to get a high investment returns. And of course, the workers and the pension plan members that have pensions are urged to accept and support this investment, the new directions in investment policy to try to establish those rates of return. I have a quick slide here that really just, the main point here is the headline, which I've already said. When people measure the scale of pension funds as investors and as global actors, pension funds can be measured at $56 trillion US. This is just enormous. The study that this slide is based on just makes one or two other really notable points. This is an organization called the Thinking Ahead Institute. What this points out is that it is primarily the 22 countries in the world with the largest pension funds that are reflected in that $56 trillion figure. So that's 22 out of 195 countries are really the source countries for these funds. And in fact, take it another step, it is in fact particularly the largest 7 countries, the largest 7 source countries that in fact source 52 of that 56 trillion is all coming from just 7 countries. I don't think people will be surprised to hear that the largest single actor here is the United States, pension funds from the United States, which have over 30 trillion of this figure. But the others are interesting to note. The United Kingdom, Canada, Australia, and then Japan, the Netherlands, and Switzerland are the others. Those 7 are they refer in this study to as the P7, the largest 7 factors. It's just worth recognizing this is a very concentrated dynamic, and it's worth taking account of that. Now, to turn to how are they invested and how are they structured? I think it's important to register in a little more detail what I said before about recent changes. Historically and traditionally, pension plans, and I think in the popular consciousness, this is reflected, pension plans were set up by employers, sometimes by governments, in rarer cases, jointly with unions. A pension board would be set up to take responsibility for delivering pensions and structuring things where contributions towards a pension are collected into a pool and then sent for investment. And the traditional model is you would hire a specialist money manager. It could be an insurance company, it could be a bank, it could be a specialist asset manager. Basically, you give them the funds and they would go and invest it disproportionately in the stock market. And in fact, in particular in the bond market, the overwhelming majority of assets were invested in low risk government bonds, sometimes corporate bonds, and low risk stocks, basically. This was the system up until the 1980s. But that is when this started to change, and we started to see what we might call a bit of a revolution in financial structures and pension investment systems. And interestingly, I'm speaking from Canada and from a Canadian experience. In fact, the pension investment structures in Canada were among the leading edge of this transformation into new directions. And in fact, the Canadian funds, the large public sector Canadian funds, are so distinctive in this respect that even outside of Canada, there's a concept now of the Canadian model of pension investment or pension plan structure. And I want to actually go to my next slide and just describe that Canadian model in a little bit of detail. And I do this not just to be parochial because I'm from Canada, but because I think this is relevant. And the Canadian model is actually lionized and celebrated on Wall Street, and it is now being exported to other countries. So we want to watch for this. What is this Canadian model? I'm going to do this quickly, even though it's a bit technical, and we can come back to this. Canadian model involves, I'm highlighting these 5 points. Number 1, rather than sending the money to outside specialist money managers on Wall Street or the City of London, instead, Canadian pension funds started to hire traders and money managers and build what they call in-house capacity to do their own trading. So they don't pay fees to someone else and contract it out. They become the money manager. And the largest 7 or 8 funds in Canada, which operate well over $1 trillion US in assets, that's what they're doing. They are in-house money managers. Number 2, scale, they are enormous. The Canadian funds, those largest 8, I believe all of them now operate and invest over 100 billion Canadian, about 80 billion US in assets. Very, very large actors. Third point, and this is the entry point for our theme today of aggressive and predatory investing. The Canadian model also has pioneered what they call asset class diversification. And what that term really means is a move away from simply passive investments in small packets of bonds and stocks in the public markets. It's a move into what they call private markets. Now the terminology is alternatives, alternative asset classes, which basically means infrastructure, used to be public infrastructure, increasingly privatized. An asset class called private equity. Private equity, very briefly, is a way of doing investing in companies or projects where the investor is a direct owner. It's not an owner of a few shares along with many others. It is the owner, either 100% owner or in many cases, a 20, 30% minority owner. But with that much ownership, you have direct control over the company. Sometimes that's done as part of a restructuring exercise. Sometimes there's different motivations for doing these operations under a private equity basis. We'll come back to this. Other asset classes include private credit. So that's basically bonds and other instruments that are traded outside of public bond markets. And of course, real estate, which is a very major category in this world. And all of the Canadian funds are very significant real estate investors. And that's all types of real estate. We'll sort of get into farmland as a version of this, commercial real estate, industrial, and in recently, increasingly, housing, including even low and modest income housing, which, as we imagine, can be troubling. I'll say quickly also, geographic diversification. The Canadian funds are among the most internationalized in the world. Some of the larger Canadian funds, strong majority of their investing is outside of Canada, an increasing percentage in the global south. Last point of the Canadian model, which maybe we'll come back to, very strangely, and I would say surprisingly, pension funds themselves have taken on something that hedge funds and other operators have traditionally done, and that is leverage. What that term means is they actually borrow money from financial markets to expand the size of their asset base and do investing and basically profit from a borrowing to invest. That's another recent factor. Add it all together, and I'll just say, again, this really has transformed what pension funds are doing as investors. One simple way I put this is they've really moved from being passive takers of what's there on the market to being active players as effectively conglomerate financial corporations, and in some cases, actual operators of companies. They actually own, in some cases, own companies outright to operate, sometimes on a long-term basis. And just the last point from this slide, just worth mentioning, analytically and methodologically, can be challenging because while we talk about pension funds as investors and actors, there are also pension funds that send money to outside specialist investors. They could be private equity funds, could be hedge funds and real estate specialist firms. So pension funds really are, as Devlin said at the beginning, they kind of show up everywhere as significant actors. Okay, so what does this mean? I'm going to pick one example of where I think we see pension funds becoming different actors, and I would even say political and policy actors in ways that would have been unheard of 30, 40 years ago. I learned a few years ago that there was a new organization dedicated to championing effectively privatization of infrastructure and a role for private capital in infrastructure. And it goes by the label Global Infrastructure Investors Association, the GIIA. This is just created in 2015. And I've put on this slide a list of the organizations, the companies and organizations that are affiliates and supporters of this association. And I think this slide, this list of actors is very powerful because what we see is a good number of the largest Canadian pension funds, and I believe they were part of the original initiative behind this. So we see, for example, the Ontario Teachers Pension Plan, one of our largest, and we see the Investment Management Corporation of Ontario. We see AIMCO, an Alberta fund. We see most of the large Canadian funds, along with some funds from other countries, and yet alongside them, what else do we see? The large investment banks, Goldman Sachs, Morgan Stanley, the big four consulting or accounting and consulting firms, KPMG, EY, Brookfield, another Canadian infrastructure manager. This is a club. This is a coordinating lobby group dedicated to lobbying at the international level within the G20, the OECD, for more privatization, more of a role for private capital in infrastructure development in particular. I think that's very important because we see pension plans are getting mobilized.
Kevin, we would love to take a quick break. How does that sound to you?
That sounds fine. Yes, I'm on the next section, so that sounds just fine.
All right, so we are ready for questions from the audience. You're welcome to enter them into the chat box or directly into the Q&A. You can use the raise hand feature for that. We have one question that we will ask now from Jim Thomas. We also had a question about the universal basic income that we will save for the final Q&A period. Jim asks, I see that global investable assets are pegged at 250 trillion. So do pension funds, $56 trillion, hold 1/5 of those? This is to help understand where pension funds sit in the greater picture on total global investment.
Yeah, very quickly, that's right. I actually saw that figure as well recently, 250 trillion. This is like a counting of all of the financial assets and debts of the world piled up into one. And I think that's exactly right. Pension funds represent this major section. We would add to that the total assets associated with the banking system globally, insurance companies, states as actors, and the bond market globally. These are really enormous, and it's maybe important to add, I don't have a chart to show this, but if we did, we would see a very significant.
Oh, we lost you, Kevin.
Sorry, I had a call came in and interrupted. If I had a chart, I would be able to show that even in the last 10 to 15 years, the amount of those financial assets has been growing exponentially. And a lot of analysts, even very mainstream analysts, I think are raising very hard questions about that pace of growth and how sustainable that is. Just one specific point, the study that showed that pension funds represent 56 trillion mentioned that number has doubled in the last 10 years. So it makes us think, well, if that pace were to continue and that 56 trillion were to become 112 trillion in 10 more years, where does that money go? What kind of tensions and contradictions is this leading to? I would argue that we're already seeing signs of these problems, and we may well see many more in the coming years.
We have another question from someone who has raised their hand, and I would like that individual to unmute themselves. Yilu Jing. You can unmute yourself and raise your question. Jonas Jacquard, you may unmute yourself to ask the question. Okay, I don't hear from Jonas, so we will begin with another question from a participant who asks, is there one sector more than others where pension funds are doing the most harm through their investments? Healthcare, food and ag, infrastructure, energy, where are they most invested and which is the most damaging?
Yeah, that's a very good question, and in fact, in the next little segment of this presentation, I'm going to show a couple of disturbing examples and examples of which sectors pension funds are now moving into as a result of these changes in investment kind of structure and strategy. I think it's difficult to determine what is the most threatening or the most troubling. In a lot of ways, my case is that they're almost all troubling in the sense that what they're about is private ownership and profiting from that private ownership, including in sectors and in so-called asset classes that are of very high social sensitivity. We talked about food and agriculture, but also, as I'm going to speak about, healthcare, education, land itself, transportation, a whole range of things. And I will also add, and this will relieve me of having to speak about it later. I think it's now very high profile that pension funds are also significant investors in the carbon economy, the fossil fuel economy, oil and gas. And obviously with the climate crisis, this is a problem. And we're going to need to find a way to transition all actors, all investors out of that world. And pension funds are very much a part of that. So it's a challenge for us.
So that concludes the initial Q&A portion. Kevin, you may continue.
Great. Thank you for the questions. And I'm going to share again my slides. Just give me a quick second. There. Hoping that is visible. So I want to turn, I think this next set will get us to some of the politics of this and questions of who controls this investment and what can we do about it. It's worth recognizing that the thought that pension funds that were going to become larger and larger could potentially be a source of power for workers and social activists, social movement players. This goes back to the 1970s. These ideas started to be developed and published and debated. And in fact, in Canada and several other countries, the idea of trade unions negotiating with their employers for what is called joint control or joint governance of their pension plans, this became a real issue in the 1980s and early 1990s. And in fact, this was achieved in many cases in Canada. Part of the thinking behind that was to protect the pension plans and benefits, and in some cases surpluses. But part of the thinking was also, we've got different ideas about how these funds could be and should be invested. So the investment part of it was part of the goal and the motivation. Now, I want to say, and this is the sort of the bad news report on our success and failure in this regard, going back to the 1990s, my view, and I'm summarizing a whole lot, is that those efforts have not been very successful. The success of trade unions who have achieved joint control, joint boards of trustees, joint governance, to actually change investment policies and practices in ways that establish a higher level of social sensitivity or limit the kinds of things that pension funds are investing in, really has not been very successful. As a matter of fact, this transformation in dangerous directions has happened alongside the emergence of these joint structures. So the question is, why is that? I've come up with a short list of 5 reasons, and I'm not going to have time to explain them in detail, but I'm going to just walk through them very quickly to put them on the table. First, as I think some people will be familiar with, there is pension funds are considered trust property. They're considered a kind of property that is invested on behalf of beneficiaries. So it attracts this idea of fiduciary responsibility for the investing entity that takes responsibility. And in the legal world, and again, this is primarily the Anglosphere, very conservative legal world, the interpretation of that duty is essentially distilled to mean you must maximize or aim to maximize the rate of return you achieve in your investment if you want to respect that fiduciary duty. For some lawyers, this is a doctrinal point. This is built into the work. And in fact, this is really a dominant part of the ethic and the culture of the pension industry. So that's important. And we can talk about that afterward. There's other points, though, as well. Some of these public sector plans in Canada have actually been re-engineered into what is called expert boards or professional boards, where in fact it's not trade unions that name workers or union representatives, to these boards. Instead, they've been forced in many cases to nominate only people with a certain technical or credentialed background, basically financial experts, to represent them on these boards. This is a very significant factor. We also see what we might call co-optation. Frankly, some union-appointed trustees will be absorbed into this world and in many ways discontinue thinking and operating as trade union appointees. There's also a basic lack of disclosure and accountability. A lot of pension plan members have no idea how their pension plan is being invested, and that's built into the system. It's very common. And lastly, and maybe this is the most political point, a lot of people, a lot of workers, a lot of pension plan members, even some people in the labor movement have the impression that they have an alignment of interests, that it's in the interests of plan members that these investment funds seek to maximize their rate of return in these conventional ways that have led to these destructive and predatory practices. So you add all those together, and I think we can see why there might be a limitation on the success and this ambition of, just appointing some union people into these roles, and we will transform how investment works. I'm going to say very quickly, there is a unifying thread to all of these sort of changes in investment, and that unity, I think it's worth talking about changes since the 1980s, capital mobility in the global South and even in the global North, structural adjustment, colonial structures and practices. A lot of it really boils down to a drive to privatize more and more of the areas of life that have not been privatized and financialized. That is at the core of what has been happening and what pension funds as actors have been taking advantage of. So I'm going to move ahead to the section where we want to talk about the real concrete reality in at least a couple of cases of what does this actually mean on the ground in the real world for the recipient countries of pension fund investment, private equity investment. Worth noting that pension funds are actually a part of the financialization dynamic, even through their investments in the bond markets and through hedge funds. People may be familiar with the horrible crisis that Puerto Rico continues to go through. They've essentially been taken over by hedge funds. Well, it's worth thinking, where do the funds come from that flow into these hedge funds? I haven't done a detailed tracing, but I know that others have, and pension funds are always represented in the funds that end up in places like buying up Puerto Rico bonds, Argentinian, even in the crisis in Greece in recent years, pension fund monies are part of the picture. But in this other world of private equity and infrastructure and farmland and agriculture, pension funds themselves have become major players. And I want to talk about this one case before I turn it over to Devlin. I have to say, of all the cases that I've been disturbed to see pension funds getting involved in, there is one just from this past year that I find incredibly shocking and disturbing and worth sharing as a central illustration of this problem. And it is an investment that took place last April 2021 by a company, a Brazilian company. This is a case of effectively the privatization of water in Brazil, led by President Bolsonaro, who worked through allies in the state of Rio de Janeiro to effectively drive through a privatization of one of the largest, I believe the largest remaining publicly owned water utility in Brazil, which was called SEDAI. We learned in Canada that our largest pension fund, Canada Pension Plan Investment Board, along with another fund called AIMCO, actually became a co-owner of a private equity company in Brazil that was working in the water sector. This was announced in March of last year, just weeks before a major auction of this public water company that was scheduled to take place at the end of April. That auction went ahead April 30th. And in fact, Sadai was chopped up and parceled out to several private investing groups, one of them led by this Igua Saneamento, this private equity company that is majority owned by these two Canadian pension funds. In fact, 86%, give or take, of the equity is these two Canadian pension funds. So they are now the owners and operators, with Brazilian support, of this public company, a formerly public water company. The company that did that is now intending to pursue further auctions and further acquisitions. And just one last point on this, this auction that took place was so politically important for President Bolsonaro that he personally presided over the auction. There's a photo here in my slides of Bolsonaro banging the gavel on the final sale of this company. Sadly, and I think revealingly, this was not reported in Canada in our mainstream media. Most Canadians have no idea that this happened with their money. Canadian Pension Plan is most workers participate in that fund. But there has been some good, very good journalism. There's a very good video that shows what happened here. I encourage people to have a look at this this really important case study of what I think is pension fund capitalism in its most predatory and disturbing form. There was mass mobilization by workers and citizens in Rio against this privatization. And of course, Bolsonaro and his agents were able to overcome that opposition. I'll stop there. There's much more to be said on it, but I think that tells us something, quite a lot, about the kinds of forms that this pension fund investment is taking. From there, I'm going to turn it over to Devlin to do a piece on agriculture and food security and pension fund involvement there.
Thanks, Kevin. Yeah, so I'm just going to talk a little bit about the involvement of pension funds in food and agriculture. One area that we're very concerned about is how pension fund managers and also private equity firms have been at the forefront of pushing ahead with these farmland funds. And these are mostly have been created since the last food and financial crisis in 2008. They are funds that are that pool together money from different investors managed by a private equity fund or another firm. And then they shop around the world, looking around the world to acquire farmland that they take over and then either lease back to large farmers, or they hire farm management companies that specialize in this kind of thing, or some of them even have their own farm management operations. And the rationale for this is that farmland is, it's a finite resource. There's only so much of it, and people still need to eat. It's a hedge against inflation. It's a hedge against the volatility of stock markets. And for pension funds, it's said to be particularly suited to them because it's something they, has a longer term horizon, and they're investors that have these longer term horizons. So it makes sense to them. By 2018, we had identified 76 different pension funds who had begun investing in the acquisition of farmland, either managing it in-house, so buying the farmland and managing it themselves, or through external fund managers. And about $15 billion US had been invested in farmland by these pension funds. A lot of that has been going to what they would consider as low risk land markets. So places like the US and Australia, where there are fairly clear property rights and where you have already a quite entrenched system of industrial agriculture. But in these places, they're driving up prices for farmland. They're increasing farmland concentration and making it much more difficult for young farmers, small farmers, particularly for farmers of color, to access farmland and extracting profit from rural communities. They also are investing a significant amount in what they would describe as frontier areas, where there's an expansion of industrial agriculture taking place, like in the southern cone of Latin America or in Eastern Europe. And there, where you have lots of land conflicts, deforestation, I mean, they are adding fuel to the fire, so to speak, and expanding this form of industrial agriculture that has multiple health and environmental impacts on local communities. One of the largest pension fund managers involved in this race for farmland is the US Teachers Pension Fund Manager, TIAA-CREF, or also known as Nuveen. And it launched two multi-billion-dollar pension funds following the food crisis and financial crisis 2008. And those farmland funds gather money from different pension funds. So not only in the US, but also in Canada, in Sweden, in the UK, in Germany, even in Korea. I pull that money together and then go out and buy farmland around the globe. And one of their main targets has been Brazil, and particularly in the Savannah region, very important biodiverse region known as the Cerrado. And that is where you're also seeing this expansion of the export production of soybeans, cotton, and other crops. And TIA was able to do this by creating this very opaque offshore structure to get around the restrictions on foreign land ownership in Brazil. And it acquired its land by buying from local businessmen, some of whom were engaged in fraud and the violent displacement of local communities. Because in this area of the Cerrado, most of the lands are so-called public lands, but what it means is they are occupied and used by local communities, peasant communities, Indigenous communities, and Quilombola, Afro-Brazilian communities. Then they would convert these lands that they've taken over. There's deforestation, there's land conversion, and they would turn them over convert them into large-scale monoculture, chemically intensive production of soybeans and other commodity crops. So that inflow of money from TIAA and from other companies such as the Harvard University Endowment has vastly expanded the land grabbing that's already happening and the expansion of this destructive form of agriculture. And that's happening in other parts of the world too. So next slide. Another area of major concern for us has been the expansion of private equity into food and agriculture as of late. Okay, as Kevin was saying, private equity funds are these special types of financial instruments that allow investors to buy control over private companies. Okay, so companies that are not listed on public stock exchanges. The funds are normally run by a small group of managers. They usually have bases in offshore tax havens, and these managers earn very high fees for which they promise very high returns. So again, extracting wealth out of these socially sensitive sectors. Today, more than $11 trillion is tied up in private equity. And it's important to note that nearly half of that money, 46%, comes from pension funds. So pension funds are a major driver in the expansion we're seeing of private equity now into food and agriculture, but also into all kinds of other sectors. In the food sector, just focusing on that, the number of private equity funds that target the food and agriculture sector has increased from just 7 in 2004 to over 300 today. And they collectively manage about $300 billion in funds. The way private equity funds invest in food and agriculture is almost exclusively in industrial agriculture, in large industrial farms, markets, and pesticide companies, And they're doing so especially in the global south. And this is contributing directly to the takeover and destruction of local food systems and the jobs, health, and wealth that these local food systems provide. On the slide here, we just have an example from the dairy sector in Kenya. Dairy is one of the targets for private equity and also for multinational food companies. And that's partly because throughout Latin America, Africa, and Asia, the dairy sector has largely remained in the hands of small-scale farmers and herders who produce, in the case of Kenya, 90% of the milk supply for the country. And that supply occurs through small networks of small-scale traders, like the women you see in the picture on the left of the screen. So about 10 years ago, one private equity fund managed by a Braj group in Dubai, with funding from the Bill and Melinda Gates Foundation, amongst others, took a 10% stake in a company called Brookside that is owned by the Kenya's ruling family, the family of the current president. That inflow of money allowed that company to expand through its own farms, but also in building up a network of larger farmers that are farming more industrially to produce a supply for them and to process the milk and even to begin setting up trading platforms. And from that, then the large multinational dairy company, the French company Danone, then acquired an even larger stake in the company, 40% stake in the company. And he is using Brookside as a sort of platform to take over the dairy sector in Kenya and beyond, because the company has now become a major trader in the region. So it just shows how that money that's coming from pension funds into private equity is then translating into direct impacts on people's lives and their ability to earn livelihoods and feed people locally. Thanks, Kevin. You're on mute, I think, Kevin. Kevin is muted, I think.
Sorry about that. I lose some control when I'm sharing my slides, so I just lost it for a second, but I will pick up. Yeah, so let me pick up on from where Devlin left off. The example that Devlin just gave of private equity channeled through, or pension funds being channeled through private equity operations into the dairy industry in Kenya, I would virtually guarantee that none of the pension plan members whose pension plans are implicated in that process have any idea. And if they did know, they would be very disturbed. I would say the same thing about my Brazil water privatization case and many, many others. And just to move from that, this also applies to all the other disturbing areas that pension funds and private equity running pension funds has also moved into in recent years. I mentioned housing before, healthcare, long-term care for seniors, education, mass transportation. There really is kind of no limit to the kinds of areas that these funds are moving to. In some ways, by stealth, a lot of people are not aware. In the second webinar that Grain is organizing for June 9th, there will be several other specific case studies examined. What I'm going to do is close the formal presentation now with just a few closing slides on, like, really the crux question that we started with, which is in many ways, what can we do about this problem? If we recognize this as, sort of analytically a distinct development and a new problem or a new structure to an old problem. What can we do about it? And let me just start by saying, opposition to these things, as we've seen in Brazil and in many other cases, it continues. But the point is that I think for a lot of us, our view is that, what investment banks or asset managers might do on behalf of the ultra wealthy or the banking system, that's kind of one category. Surely, I think in the back of our minds, we think if it's pension funds, surely that suggests that there might be a strategic opening for different ways to organize opposition and to challenge these kinds of investments that are predatory, socially predatory, ecologically harmful, and so forth. Well, just to look back and say, what I want to talk about is sort of two broad directions for strategies. There has actually been, for more than 30 years, one direction for how workers, trade unions, social activists can try to direct their pressure and concern in relation to what pension plans are doing as investors, and in some ways, the companies that pension plans invest in can be influenced. And that, broadly speaking, I would call the shareholder activism strategy. Use shares you own or portions of companies that you own as a pension plan, or urge pension plans who own these shares to respond to social concerns. I want to argue that there are limitations to those strategies, and that there are, in fact, a new set of strategies that I would argue are more ambitious and more likely to be successful. But what I want to do, just in the limited time we have left, is just sort of put a little bit of a map of the distinction between these two categories of strategic action. Now, this is a bit political and I expect might be a bit provocative, but that's really, I think, the point of this session this morning is to put these things on the table for discussion. I'm calling that first category I referred to as insider strategies. In other words, using the structures that we have from inside, either through pension plan investment policies or trade unions that have seats on boards. We are urged under this strategy to consider proxy voting strategies, engaging in direct dialogue with companies that are involved in problematic investments. The latest label that some people may be familiar with that has become popularized goes by the acronym ESG, which stands for Environmental, Social, and Governance Risk Factors. So it's sort of a repackaging of socially responsible investment, but I think it's an even more limited sort of framework. But this is the sort of the insider track for how to make corporate actors and pension funds more socially responsible. You even see the language of caring capitalism sometimes attached to these strategies. I want to make a case for category two, which I've called here the outsider strategies. And maybe this can lead to a bit of discussion. What are outsider strategies? Well, simply mass mobilization of opposition is sort of one, and that's something that unions, movement actors can get involved in on a case-by-case basis. We can also call for government action to stop what some of these funds are doing. In Canada, there was some initial steps to demand that the Canadian government intervene with the Canada Pension Plan that was doing that Brazil water privatization and demand that they put a stop to it. So the demand was articulated, it was ignored, but that is a direction to go, straight to government. Interestingly, one of the most significant campaigns during the time of the pandemic in this regard, one of the unions that represents federal government employees in Canada, the Public Service Alliance, discovered early in the pandemic that one of the largest corporate long-term care companies in Canada, which was exposed as having a terrible record for their care. The death rates were very high. It was a for-profit company with a terrible record. It's called Revera. That company is 100% owned by their pension fund. The Federal Public Service Employees Pension Fund owns Revera outright. What that union did was demand not that they introduce ESG policies or socially responsible principles, but in fact that Revera be nationalized, be transferred into public ownership to take the profit motive out of that form of healthcare. That's a more structural outsider kind of strategy, which I think has promise. And to underline that point, in fact, there are some asset categories that are legally restricted, even in a place like Canada. Farmland in some regions is not allowed to be sold to financial actors, to financial institutions, including pension funds specifically. It's restricted. It's recognized that this is threatening and a problem, and so it won't be allowed. That concept could certainly be expanded, I would argue, beyond just the categories that it currently applies to. But the last point, a really political point, I want to argue, and I've argued in some of my writing, that this problem of predatory pension funds and predatory finance reflects a problem with a kind of out of control private financial system that simply needs to be reined in. We can't have, I would argue, our pension plans and our pension benefits secured by financial markets and financial assets. And there was no reason that we had to have that in the first place. I have argued that we can and should find a way to transition out of this existing financialized pension framework that is dominant in Canada and many other countries, and move to a system that's based on social solidarity and coordinated through the state. I'll just finish the last point at the bottom there. Arguably, there are other strategies that people have, like that we've been hearing about around divestment, possibly reinvestment. These things could fall into either category. Maybe we can talk about that. And another thing that probably cuts across is simply strategies that demand more disclosure, more effective and proper disclosure to plan members of what their plans are actually doing and how they're invested. My last slide and my last point, and this is kind of my wrap up. As I said at the outset, I think what these disturbing investment practices and patterns are showing is that when we have our pensions so anchored in the private financial system, what we end up with is a kind of dependency. Workers that have these financialized pensions, and it could be through a formal pension plan, and in some ways it is also through, 401ks or what we call RRSPs in Canada. Either system, there's this dependency on those funds being invested and generating a high rate of return. And we all end up with this strange consciousness of hoping that the rate of return on those investments is very high so that we can have pension benefits at the end of the day. This is a problem. I want to argue that in fact there's a double dependency involved, because it's not just the dependency on the high returns. For those high returns to happen, we have a dependency on the conditions out there in the investable asset market to be favorable for those high returns. That means public policy that facilitates it, and a broader set of factors that is actually, really troubling. We need to, that means overcoming social resistance, overcoming, trade unions and other movement actors that might be a problem for achieving those rates of return. And I'll just finish kind of reiterating, I think there are ways to get out of this problem. It's a major political challenge to us. To even start to imagine transitioning away from this system. But I would also argue that we don't have a choice. The existing financialized system It was always a problem. It is now becoming a gravely serious, crisis-oriented problem that we really need to find ways to build a challenge to. And with that said, maybe I'll close there, and Daljit, maybe we can open up for questions, and I will stop sharing my screen.
Thank you, Kevin. That was wonderful. So it is now time for our final Q&A period. We have some questions already, and if you'd like to get your questions in, please enter them into the chat box or directly into the Q&A box. The first question we have was from the previous portion, and it is about universal basic income and how the struggle for that relates to changes that we need to make around pension funds. Is this part of the solution?
Sorry, I just missed a portion of that. Can you just repeat the question?
Sure. So an anonymous attendee asks, how does the struggle for universal basic income relate to the changes that are needed with pension funds?
Okay.
Is that part of the solution?
Right, UBI, universal basic income. I think it's a fair question because the crisis period that we're experiencing right now is very much about an income crisis. We now have inflation in many countries emerging as a new, very troubling problem, and inadequate incomes. So the question is the recent demands for universal basic income potentially a support for my call, or the call that we all might want to make around universal and adequate pension systems? I think quite possibly the answer is yes. I think everything goes on the table in our discussion about how to resolve this. And I think it requires us to think very hard about how about levels of income that we consider to be adequate, and the extent to which our incomes are being shaped by either a labor market or a wage market that has problems and needs change, and also this financial market that is overly influential in determining these incomes. I think it's a very good question. I don't really have a definitive answer to that, except to say I think we need to talk about income policy across the board, and this portion of our income, our lives, and our need for reasonably adequate incomes in our older age, in retirement, very central to this debate.
So we can explore that further in the second webinar as well on June 9th. The second question is a 2-for-1. Gary Turner asks, are we moving into a phase where commons-based approach to both financial and resource allocation becomes central? Will those 7 countries ever honestly relinquish or decentralize power, or must we see a full systematic collapse for a complete reimagining to be possible? And hold that, because Peter Rossman asks a similar question in that same vein. Is a third strategy feasible, which would be delinking pension provisions from private financial markets and then bringing it under public control?
Yeah, there's a lot there in both of those questions. But just to pick up on what Peter said, I think that's right, and I will plug one of my own publications. In the book that I flagged right at the outset, the Contradictions book that's right there behind Daljit.
You can order it online.
Yes, I was a co-author of the final chapter in that book with Sam Gindin, a colleague based in Toronto. And what we tried to do in that chapter was talk about, what would it look like to move from Canada's existing very financialized pension system, like one of the worst, or one of the most significant in the world, to a non-financialized retirement income system. And we actually sketched out a map, like almost a step-by-step map to how to do that. And really what it involves, and this is what Peter is referring to, would be a major expansion of the 2 existing public pension systems, so that those public systems that are funded through the still somewhat progressive tax system, and also contributions from workers on payroll into pension payments, that don't end up cycled through the stock market or private equity or these other troubling things. We have a map for how to do that. But of course, the question is, how would we build the political support, the social and political support to try to transition out of the existing system? My main argument, I think, and because maybe we're at early stages of this, but my main argument is most people, most pension plan members and workers are not even aware of the scale and the nature of this problem. I believe if they were, and in fact, even to take it another step, I think a lot of people have been convinced that the financialized system is the only way to organize pensions, and that it is in their interest to have a financialized plan that hopefully makes a very generous rate of return, and that will be their source. So we actually have a challenge in front of us to challenge that thinking and to actually build the confidence that actually there's another way. The good news in Canada is that, in fact, both of our public systems up until 1998, fairly recently, were non-financialized systems. The Canada Pension Plan, this actor that's now in Brazil's water system, up until 1998, the investment policy, much smaller fund, the policy was to loan the pool of funds that were aggregated to provincial governments to build public infrastructure. Well, that's a far better way of organizing a pension system and even an investment system than where we've ended up today. So the models are actually there. This is not pie in the sky, but it will take building the political mandate and the consciousness of the need to do this.
And that's why we're all here. So we are at the stages of movement building on these issues. We have another great question from Hendro Sankoyo, sorry. He asks, or she, is there any estimate of the share of pension funds that are invested in mining in Canada, for example? Recently, we found out that the Indonesian BPJS Healthcare and Social Security Agency invested its funds into a large Thai-owned coal mining project in East Kalimantan.
I very much appreciate the question there because, of course, also speaking from a Canadian perspective, Canada is a source of it's really the home of the global mining industry. We have terrific organizations like Mining Watch that work on this. But the question is quite right. It is such a large industry in Canada and outside, and pension funds are very significant investors within that industry. I expect you would find this in virtually every major mining operation, including the most socially and ecologically threatening in the world. You would find pension fund investors or participants possibly channeled through the public markets, investing in mining companies in their shares, possibly in other ways, sometimes even complicated ways where one operation is around the water provision to supply water to the mining operation. There's lots of complexity to it. But absolutely, this is very much part of this picture. And, as we step back and look more and more broadly, it's not a simple path to challenging this. But also, as I say, I don't think we have a choice. This is not building the future we want and that we need to do. So we've got to start somewhere. And I think private finance is a very important strategic target, and pension funds, as I've been arguing, is this central factor and force within private finance where we actually do have some strategic openings to try to build the challenge.
We have another related question about resources, natural resources. Madeline Fouch asks, in addition to the atrocious privatization of water and land grabs in the global South, how are pension investments driving the housing crisis, wealth asset inequity, and displacement of communities in the United States?
In the United States, well, this is an excellent question. Again, like each one of these little envelopes, these categories, it merits, a webinar of its own because this is a very significant, I would argue, a growing problem. The person who asked the question probably is aware that in the wake of the financial meltdown of 2007, 2008, There was mass evictions across the United States, a mass drop in valuations of housing stock. And who was it that swooped in and bought up a whole raft of hundreds of thousands of units of housing, including single family dwellings and housing in California and all different parts of the United States? It was private equity. It was the private equity into Blackstone. I don't know if it still is, but at one point, Blackstone is one of the largest private equity investing companies in the world, significantly investing on behalf of pension funds. They are, I believe, the largest landlord in the world now as a result of that crisis. But it's not just Blackstone. The same pension fund in Canada that I mentioned owning Rivera, this long-term care healthcare company, was exposed some years ago as having invested, get this, they bought up some social housing in Berlin, in Germany, that had been privatized by, I believe, the municipal government that was financially desperate at the time, and was operating essentially as a landlord secretly through shell companies based in Luxembourg and other complex, opaque structures. This workers' pension fund in Canada was involved in privatizing like affordable social housing in Germany. I mean, it's just that's really just the tip of the iceberg. The housing issue, I believe, should be a central discussion in the labor movement and the housing rights movements. And the person asked the question was focused on the United States, but housing is a crisis. I think it's a global crisis that is very much a product of the financialization of housing, and we've got to talk about it.
Absolutely. We have another great question by Jim Thomas, who asks, it seems to me that a worker whose pension money is being used has a commercial relationship with the fund, since the funds are using their money. Do they have any contract language about what can be done with their money? Are there creative legal actions such as class action lawsuits or other strategies that can be brought by workers?
That's an excellent question. One short answer, which I'm able to speak to, is the idea. I mean, I'm really supportive of the idea of trade unions, for example, who have pension entitlements, trying to negotiate, maybe in their contracts or some other legal framework, a limitation on what their pension funds can invest in. The short answer is no, that really doesn't happen, or it's extremely rare and extremely limited for some of the reasons I talked about: fiduciary duty, who's actually in charge, how much real role and influence is there. All those reasons are there. But, I guess I would say this in terms of the role of unions. I mean, I work for a trade union, and I'm frankly, while I'm sometimes critical, I'm very proud that CUPE and some other unions, but I would say in particular CUPE in Canada, has actually passed policy statements saying things like, we do not accept or want our pension funds being invested in ways that are against the interests of our members, that support privatization of vital public services and public infrastructure. We oppose that, even though we know our pension funds might be beneficiaries of the rate of return that might be generated. I'll say, there are many trade unions that haven't issued statements like this. They haven't developed that kind of policy orientation. Now, I'll quickly say, it's one thing to set a policy and say that, to actually do the work to figure out how to implement that and how to enforce and make that happen. That's the question before us. But there is certainly, I guess, on the more critical side, I won't hesitate to say, I think there are some trade unions that could be doing and saying a whole lot more about this problem, and many do not. So I think that's a challenge. There's a whole lot of reasons for it, but it's an immediate challenge. I would encourage anybody who is in a trade union or has contacts with the movement to take this up. We need this to be raised and debated inside and outside the labor movement.
I couldn't agree more. So that was our final question, but please, I wanted to say thank you to everyone who's raised these wonderful questions. We have saved the ones that didn't get answered, and we will address them in either the post-webinar email communications or on June 9th in our final webinar in this series. It is time for us to wrap up. Kevin and Devlin, thank you so much. You've expanded our knowledge base on a topic that is so massive in scope and scale. So thank you. I'd also like to say thank you to the interpreters. We deeply appreciate your contributions today. And also to you, the audience. We really appreciate your presence today. It's with you that we'll be able to build the next stage of this movement. So we encourage you to please reach out to us, share your ideas, your thoughts, your experiences. You can email Grain at info@grain.org. And we also want to make sure that you are registered. If you were registered for this one, you will automatically be registered for the next one. So please save the date and let other people know about June 9th. We're really excited about that webinar because that one's going to really focus on the direct impact of pension fund investments on people and places. And so we're excited to announce that some of our speakers include Francisca Barriga from Fundación Sol in Chile, as well as Maria Luisa Mendoza of the Network for Social Justice and Human Rights in Brazil. And this webinar is really going to get us thinking about the concrete ways that we can challenge pension fund investment, the strategies for collective actions that will be capable of securing a just retirement for all workers and a fair system of investing public funds. Thank you so much to everyone.